Did you know that in just 1 week, silver prices soared over $6 per ounce, climbing past $56 and far outpacing the rise of gold? Behind this stunning jump is no coincidence. It's a combination of economic fluctuations, trading glitches, weakening production signals, and expectations of an upcoming Fed rate cut, all igniting the silver surge at once. What is really happening? And could this be the start of a new price era? In just a single week, the silver market experienced an extraordinary surge. Looking back to November 21, silver was priced at only $49.79 per ounce. By November 28, it had jumped straight to $56.32, an increase of over $6 in just 7 days, a pace investors had long anticipated. Even more striking, compared to the end of May, the rise has reached $23 per ounce. This isn't just a routine price move. It signals that the silver market is entering a period of strong volatility, with unprecedented buying pressure and investor sentiment hitting new highs for the year. Another key development drawing investors' attention is the rapid narrowing of the gold-silver ratio. It has dropped to around 75-1, significantly lower than in previous months. This means to trade 1 ounce of gold, investors now need only about 75 ounces of silver, showing silver is regaining strength relative to gold. When the ratio narrows, analysts often see it as a sign that silver is undervalued with substantial upside potential. This shrinking gap makes silver increasingly attractive, drawing new capital and boosting expectations for the next price surge. The strong silver surge is driven by a perfect storm of economic and market factors occurring nearly simultaneously. First, a rare technical glitch at CME disrupted trading and created unusual volatility when the market resumed. Then, regional PMI unexpectedly plunged, signaling serious weakness in the manufacturing sector, a typical trigger for investors to flock to safe haven assets like silver. On the other hand, durable goods orders rose unexpectedly, showing that demand remains strong in certain sectors. Additionally, the latest labor data indicate the U.S. job market is still robust, with unemployment claims hitting a 7-month low. This combination of weaker manufacturing, stable consumer demand, strong employment, and unexpected trading disruptions has funneled capital into silver as an asset both safe and potentially profitable in volatile times. Market trends show that silver is accelerating faster than gold. In a single trading day, silver jumped more than 5.5%, while gold only edged up about 1.38%. This stark difference reflects a familiar market characteristic. Silver often starts from a much lower price base than gold, so when buying pressure rises or macroeconomic events occur, it reacts faster and more sharply. This relative undervaluation consistently allows silver to achieve larger gains, especially during periods of anticipated rate cuts or economic uncertainty. As a result, silver has become an increasingly attractive precious metal. A major factor pushing silver prices higher is that the market is pricing in an expected Fed rate cut. Many investors believe that the Fed will begin easing policy at its December meeting, and this expectation has quickly reflected in silver prices. In financial markets, once a rate cut is anticipated, capital tends to flow early into store-of-value assets like silver. Notably, prices often rise before the Fed officially announces a decision, simply because investors don't want to wait and risk missing opportunities. This proactive mindset has significantly contributed to silver's recent strong performance.
The latest economic reports paint a mixed picture, but overall trends lean toward a weaker U.S. economy. Unemployment claims unexpectedly fell to a 7-month low, suggesting some strength in the labor market. However, these positives are overshadowed by weaker than expected data elsewhere. Manufacturing orders rose only slightly, insufficient to meaningfully improve the sector. Most concerning, the Chicago PMI plunged to 36.3, an extremely low level usually associated with deep contraction in production activity. When PMI falls below 40, it reflects shrinking output, reduced orders, and concerns about future demand. Taken together, these data indicate the economy is facing greater pressure than anticipated. Silver has become a focal point for investors due to its dual role as both a critical industrial metal and a valuable safe haven asset. This dual nature allows it to benefit from both industrial demand and financial market volatility. In industry, silver is widely used in green energy sectors such as solar panels and clean power systems due to its conductivity and durability. The electric vehicle industry also consumes large amounts of silver for batteries and electronic components. Additionally, the rapid growth of data centers and AI applications further increases silver demand, as it is a key material in circuitry and high-tech devices. The combination of industrial importance and safe haven characteristics makes silver an appealing investment during economic uncertainty and technological expansion. More investors recognize its long-term potential and are investing, driving prices higher. Since early October, silver prices have experienced extreme volatility, repeatedly fluctuating between 47, 50, 53, and most recently, 56 per ounce. This rapid and large movement reflects the market's sensitivity to economic signals, labor data, and monetary policy expectations. With such continuous swings, investors need to be mentally and strategically prepared, as prices in the coming days may continue rising or falling sharply, presenting both opportunities and significant risks. The big question now is whether silver's sharp rise marks a long-term breakout or just a short-term volatile spike. In commodity markets, rapid gains often come with intense fluctuations, as investors quickly take profits or adjust positions. The key is to monitor whether silver establishes a new price floor, creating a foundation for sustained upward momentum, or reverses sharply, returning the market to previous levels. Although this is not financial advice, the author believes that in 20 years, those who start accumulating silver today will not regret it. He follows a long-term, deep stack strategy, focusing on accumulating and holding silver despite short-term market fluctuations. Rather than worrying about temporary swings, he emphasizes the importance of long-term trends and intrinsic value, an approach that helps investors maintain confidence and capture sustainable growth opportunities.